Welcome back to the channel where we skip the academic garbage and look at the actual math driving the markets. Look, I am not some 70-year-old teenager named Clive Thompson who tells you he has been watching charts for 50 years just to give you generic financial disclaimers. I am a 27-year-old active investor who actually has skin in the game and built a verified net worth of $124,560 from absolute zero. I achieved that result by driving a beat-up 2006 sedan, refusing to buy a couch for my apartment for a whole year, and tracking raw capital flows while everyone else was busy buying luxury items. So listen to your hardcore older brother on this one, because what we witnessed in the global markets this week was pure, unadulterated structural insanity. We are staring at an economic setup in 2026 where core inflation is accelerating rapidly, while the retail herd is blindly celebrating near all-time highs. If you keep throwing your hard-earned cash into passive indexes right now without understanding the global liquidity pipeline, you are going to get absolutely cooked. Let us break down the raw numbers, because the data dropping on the tape right now is getting completely out of hand. On Tuesday, May 12, 2026, the Bureau of Labor Statistics released the Consumer Price Index data for April, and it was an absolute disaster. The headline Consumer Price Index came in at a staggering 3.8% per annum, meaning your purchasing power is evaporating faster than Wall Street wants to admit. Even worse, the month increase alone printed at 0.6%, which mathematically annualizes to an absolute terrifying run rate of over 7% inflation. The institutional blind followers will try to tell you this is just a temporary spike driven entirely by the ongoing energy blockade inside the Strait of Hormuz. They want you to look at core consumer price, which excludes food and energy, but even that manipulated metric clocked in at 2.8%. Remember that the Federal Reserve has a hard target of 2%, so we are miles away from a stable monetary baseline. When you look under the hood at the physical economy, things look even more catastrophic for the average working class person. The official statistics show that raw energy costs are up a mind-blowing 17.9% year over year, while basic gasoline has surged by 28.4%. If you walk into a grocery store, food costs are continuing to climb, with beef prices alone skyrocketing by 14.8% over the past 12 months. Airline fares have ballooned by 20.7%, making standard travel completely restrictive for ordinary people. But here's the absolute most painful metric that will make you realize how hard the middle class is getting squeezed right now. Real hourly wages for actual workers dropped by 0.3% compared to last year, meaning you are working just as hard but literally going backward in real terms before this geopolitical crisis escalated. In late February, inflation had cooled all the way down to a manageable 2.4%. Now the economic trendline has completely reversed and is charging aggressively in the wrong direction. The nightmare intensified on Wednesday when the government dropped the Producer Price Index, which measures what factories are paying for raw materials. The Producer Price Index for April printed a massive monthly increase of 1.4%, which annualizes to a horrific 16% wholesale inflation rate year over year. Producer prices are up a clean 6%, which tells you with absolute mathematical certainty that consumer prices are headed much higher. Factories do not just absorb massive input cost increases out of the goodness of their hearts. They pass those exact premium costs directly down to the consumer. Even if you strip out food and energy from the wholesale ledger, the core producer price index rose by 1% in a single month, completely crushing the consensus forecast of 0.4%. This data has officially obliterated any statistical probability of a Federal Reserve interest rate cut happening in the second half of 2020. Just a few weeks ago, the financial mainstream was confidently predicting at least one rate cut before the end of the year, but that fantasy is entirely dead. Now, the real options contract market is pricing in a staggering 50% probability of an actual interest rate hike. Before the year concludes, the central bank has been sitting entirely on its hands, keeping the benchmark federal funds rate locked between 3.5% and 3.75%. They voted 3 separate times already in 2026 to keep policy completely unchanged, but the internal cohesion at the central bank is completely fracturing. During their last policy meeting, there were 4 historical dissenting votes, which represents the highest level of internal disagreement since the year 1992. The new Federal Reserve Chair, Kevin Warsh, was officially confirmed by the Senate last week and fixed income markets immediately went into a tailspin. Yields spiked aggressively around the globe, pushing the pricing of sovereign treasury bonds straight off a cliff. Let us look at the raw math of real interest rates, because this is where the average retail saver gets completely demolished without realizing it. If you lock your capital into a 10-year treasury bond yielding 4.6% while current headline inflation is running hot at 3.8%, your real yield is a pathetic 0.8%. That is a microscopic positive return before you even factor in state and federal taxes, meaning your real wealth generation is practically zero. And if you look at the benchmark federal funds rate sitting below 3.75% against the 3.8% inflation print, the short-term yield is officially negative. Historically, holding your capital in an asset class with a negative real rate of return is an absolute guaranteed way to destroy your buying power over a 10-year horizon. Look at the absolute carnage that hit the global fixed income markets on Friday as bond yields experienced a brutal upward spike. To understand the violent mathematics of bond pricing, you need to understand that long-duration assets carry immense structural risk. When yields climb, if interest rates move up by a full 1%, a standard 30-year Treasury bond can experience a price drawdown of roughly 30%. On Friday alone, the 10-year yield surged by 14 basis points to close at 4.595%, while the 30-year yield crossed deep into dangerous territory at 5.121%. The 2-year note climbed to 4.079%, confirming that institutional money is demanding a massive risk premium to hold government debt over in the United Kingdom. The 10-year gilt yield surged toward 5.1%, hitting its highest level in nearly 20 years as political chaos added absolute fuel to the fire. The health secretary resigned to launch a direct leadership challenge against the prime minister, and global capital completely fled the British market, moving across the Pacific. The Japanese fixed income market just experienced a historical regime change that will alter global capital flows forever. The 30-year Japanese government bond yield hit 4% for the first time since the year 1999, marking the lowest asset prices that market has ever seen. Their 20-year bond yield printed the highest structural level since 1996, while the 10-year note climbed to 2.7% after a decade of trading near absolute zero. Producer prices in Japan are currently accelerating at a 4.9% annualized clip, completely ending the era of ultra low interest rates. This is catastrophic news for the institutional carry trade, which relied on borrowing cheap Japanese yen to buy higher-yielding tech assets. In the West, Japan is currently carrying one of the highest debt-to-gross domestic product ratios in the civilized world, and rising yields make servicing that debt impossible. Yet despite this absolute mountain of terrible macroeconomic news, the major United States equity indexes somehow managed to end the week completely flat. The S&P 500 and the Nasdaq are hovering within a single percentage point of their absolute historical highs because the entire index is being artificially sustained by a tiny handful of technology giants. If you remove a company like Nvidia, which currently commands an insane market capitalization of $5.7 trillion, the broader market looks completely different. The United States equity market has dramatically outperformed European and Asian indexes by a clean 10% margin. So far this year, that performance gap exists because the United States acts as a net energy exporter, while Europe and Asia are getting absolutely throttled by high oil import costs. Furthermore, the domestic market is riding a massive speculative artificial intelligence chip boom that is drawing in all the global liquidity. But do not let that short-term index resilience fool you, because a massive structural correction is positioning itself to be far worse than the dot-com bubble. During the dot-com boom of the year 2000, the market speculation was driven almost entirely by abstract hopes, forward expectations, and unmonetized web traffic. This 2026 cycle is fundamentally different because it is driven by massive real-world physical infrastructure capital expenditure. We are talking about hundreds of billions of dollars being poured across the continent into the physical construction of next-generation high-density data centers. This trend is driving real resource consumption across regional power utilities, massive industrial water systems, and localized engineering workforces. Because the physical economy is carrying this technological boom on its back, any sudden structural correction will be felt across every single sector. In the year 2001, if you did not own speculative internet stocks, you could sit back and watch the tech crash without taking a direct hit to your portfolio. In the second half of 2026, you will not have that luxury because a liquidity reversal inside the data center pipeline will trigger a broad macroeconomic hangover across real estate, utilities, and industrial manufacturing. Look at the geopolitical map, because the economic proxy war that ignited on the 28th of February has completely engineered global trade logistics. The physical closing of the Strait of Hormuz has choked off roughly 20% of the global daily oil supply, causing crude prices to skyrocket. By nearly 60%, crude was trading comfortably in the $60 range before the conflict, but it is now locked near $100 per barrel. Depending on the weekly headlines, President Trump recently flew out to Beijing for an emergency two-day summit with the Chinese leadership to address the maritime gridlock, while both nations openly agree that the international shipping corridors must remain open to sustain energy flows. Trump left the summit with zero concrete breakthroughs. He even dropped a reckless throwaway comment stating that the United States does not fundamentally need to police the strait, which immediately sent energy prices higher. The institutional market was treating that international summit as a hard psychological deadline for a resolution, but negotiations remain completely stalled. This means you must extend your internal time frame for how long inflation will remain sticky, because high input energy costs are here to stay. This macro pressure explains why precious metals like gold and silver experienced a violent short Term liquidity flush this week. Gold dropped by 4% on the week, pulling back 18% from its absolute historical peak, while silver got absolutely hammered by 13% in a single day. On Friday, retail amateurs are losing their minds asking how an inflation hedge like gold can drop when consumer price prints are accelerating. Across the globe, the answer is incredibly simple. If you look at the opportunity cost of capital rather than emotional retail narratives in the short-term, gold is reacting directly to the aggressive spike in real treasury yields and a rapidly strengthening United States dollar. When an investor can suddenly capture a guaranteed 4.6% nominal yield on a government bond, the immediate incentive to hold non-yielding physical commodities drops. Furthermore, when the dollar index strengthens, it automatically suppresses the international dollar-denominated price of global commodities. You also have to realize that the precious metals market became incredibly crowded during the massive parabolic run-up we witnessed in January. Whenever institutional funds face sudden margin pressures or need to raise cash fast, they always liquidate their most profitable positions first. Because gold has been a massive winner for anyone who accumulated shares over the trailing 12 months, it acts as an immediate corporate cash machine during a macro squeeze. But listen to me closely, because the long-term structural bull case for hard assets has not been altered one single bit by this short-term pullback. Historically, the absolute largest capital gains inside the gold market do not occur at the exact moment interest rate hikes are introduced. The true parabolic runs historically ignite between 6 and 18 months after the central bank tightening cycle peaks, and real short-term yields turn deeply negative. We saw this exact mathematical playbook manifest during the inflationary decade of the 1970s, when real yields cratered below zero. During that historical era, physical gold went on an absolute legendary tear, skyrocketing from $35 an ounce to a peak of $850 an ounce. That structural move delivered a mind-blowing compound annual return of roughly 45% over a multi-year horizon. People realized that holding cash or low-yielding government bonds was an absolute guaranteed way to watch their purchasing power get incinerated by inflation. We are standing at that exact same macroeconomic junction today, because central banks will never be able to raise interest rates fast enough to outpace structural inflation. Modern sovereign governments are carrying an unprecedented mountain of national debt that completely prevents them from executing a historic Paul Volcker-style shock. Back in 1980, Volcker was able to aggressively crush inflation by driving nominal interest rates all the way to an absolute insane peak of 20%. If the current leadership team tried to push interest rates even close to those double-digit levels today, the interest expense alone would completely bankrupt the federal budget. Within 90 days, they are completely trapped, which means structural inflation will be deliberately allowed to run hot while real yields sink deeper into negative territory. Switching over to the technology sector, the absolute defining event of the quarter is SAT. Yield to drop next Wednesday, with NVIDIA's corporate earnings release. The operational bar for the entire artificial intelligence hardware ecosystem has been set to a level of absolute flawless perfection. When you look at the data from NVIDIA's last 4 consecutive market reports, their stock price actually dropped immediately after the release, despite beating Wall Street consensus estimates. The mega cap tech elite, including Microsoft, Amazon, Alphabet, and Meta, are still projecting to deploy tens of billions of dollars in capital expenditure into 2026. But the dirty little secret that mainstream finance channels will never tell you on camera is that it is currently costing these platforms significantly more cash to run advanced models than they are actually recovering from the retail consumer. We are living through a massive digital infrastructure bubble where companies are deliberately running massive operational losses just to capture early market share. They are trying to execute the classic ride-sharing playbook by subsidizing the technology to get the retail public completely addicted before raising subscription prices. But the structural flaw in that strategy is that the artificial intelligence landscape faces a level of hyper-competition that never existed in the ride-sharing space. Every single legacy technology platform in America is simultaneously launching competitive models, completely destroying any long-term corporate pricing power. Competition completely erodes corporate profit margins and forces prices down inside an industry that is already fundamentally burning cash to survive. So while I am incredibly bullish on the long-term physical utility of automation technology, I am deeply bearish on the current premium multiples being paid for these overhyped tech shares. The stock market is placing a dangerous bet that a tiny handful of chip designers and data center builders can carry the entire domestic economy on their backs forever. The old economy is already suffering immense structural damage from high energy input costs, sticky inflation metrics, and spiking fixed income yields. If you keep blindly hiding your capital inside passive tech-heavy index funds without an active risk management framework, you are setting yourself up for total disaster. Stop falling for the generic buy and Hold propaganda being pushed by mainstream legacy channels who do not track raw capital velocity. Change your financial environment. Protect your investment capital. Sign up for the free bi-weekly newsletter down in the description box. And let us navigate this great market flip together. Go ahead and click on either of the two deep dive strategy videos displayed on your screen right now to keep your financial education moving forward. Make sure you hit that subscribe button right now. Drop a comment below with your exact asset allocation strategy, and always keep your investing completely simplified.